Hello guys, in May you just built a regression model that predicts stock returns, and the R-square looks impressive. Several variables appear statistically significant. You present your finding to your investment commit, and 6 months later, the strategy completely falls apart. What went wrong? The problem wasn't necessarily the data. It wasn't even the regression model itself. The real issue was that the assumptions behind the regressions were widely being violated. And here's the important part. Regression software almost never flashes a yen warning saying your conclusions are unreliable. Instead, it gives you a beautiful looking number that can lead you to very expensive decisions. So, in these lessons, we are going to explore the 3 regression problems every finance student must recognize: heteroskedasticity, serial correlations, and multicollinearity. More importantly, we will learn how professionals detect them, why they matter, and what to do when they appear. So, why regression assumptions matter? Before we study the problem, let's understand why regression assumptions exist in the first place. Think about regressions as a measuring instrument. Imagine using a ruler to measure a company revenues. If the ruler is accurate, your measure is trustworthy. If the ruler is bent, every measurement becomes questionable. Regression assumptions work exactly the same way. The regression coefficients themselves may still be close to the truth, but if the assumptions are violated, the statistical tests surrounding those coefficients can become misleading. And that's the dangerous part. Because investment decisions are rarely based only on the estimated coefficients, they are based on questions like: is this variable statistically significant? Can we reject the null hypothesis? Should we include this factor in our valuation model? These decisions depend heavily on standard error, t-statistics, and p-value. So the real purpose of checking regression assumptions is to make sure our statistical conclusions are reliable, not just our coefficient estimates. Before discussing the 3 classic violations, let's talk about an even bigger issue: model misspecifications. Here's the intuitions. A regression model is only as good as the variables you include. If you leave out an important variable, or include variables that don't belong, or choose the wrong relationship between variables, then the model itself is flawed. Imagine trying to predict house price using only the number of bedrooms. You ignoring locations, neighborhood qualities, school district, and interest rate. The regressions might still produce numbers, but the model is incomplete. This is called model misspecifications. Suppose we test the overall regressions using the F-test. If we reject the null hypothesis, that tells us at least one independent variable contributes meaningfully to explaining the dependent variable. Notice what it does not tell us. It does not guarantee that every variable is useful, and it certainly does not guarantee that the model is correctly specified. A statistically significant regression can still be a poorly designed regression. Professionals always combine statistical testing with economic intuitions. Now let's discuss the first major violations, heteroskedasticity. The word sounds intimidating. The intuition is actually simple. Normally, regressions assumes that residuals have roughly the same variance across all the observations. Think of throwing darts at a target. If every throw has about the same spread, the assumptions hold. Now imagine that as the target gets farther away, the darts spread out much more. The amount of uncertainty changes. That's heteroskedasticity. In finance, this happens all the time. Small companies often have relatively stable earnings. Large companies may experience much larger swings in profits. The variability changes depending on the level of the independent variable. Now here's the key implications. The coefficients is estimate remain consistent. That's the good news, but the standard error become underestimated. And underestimated standard error make the statistics look larger than they should be. As the result, analysts reject the null hypothesis too often. This increases the probability of a type 1 error. In other words, you think you discovered a meaningful relationship, but it actually isn't statistically significant. Professionals usually detect this problem using Postbagen tests. And rather than rebuilding the entire model, they typically correct the standard error using wise robust standard errors. Notice that strategy. We are not changing the coefficient estimate, we are making the statistical inference more reliable. The second violation appears more often in time series analysis. Serial correlations, also called autocorrelations. Think about forecasting monthly inflations, or GDP growth or bond yields. Today's economy influences tomorrow's economy. Instead of each residual being independent, they become connected across the time. Positive serial correlations is especially common in financial and economic data. Why it is a problem? Again, the regression coefficients themselves remain consistent, but the standard error becomes too small. Just like heteroskedasticity, that creates inflated statistics, which again increase the likelihood of type 1 error. Investors may incorrectly conclude that a macroeconomic variable has predictive power when the apparent significance is simply created by correlated residual. Professionals usually detect serial correlations using Brose-Godfrey tests. The preferred corrections is often Newey-West corrected standard error, which are designed to handle both heteroskedasticity and autocorrelations. This is why Newey-West is widely used in empirical finance research. The third problem is very different, multicollinearity. Instead of looking at the residual, we are now looking at the independent variable themselves. Suppose you are trying to explain stock returns using both short-term interest and central bank policy rates. Those two variables often move together, or image using both company revenue and company sales, depending on the accounting definitions. They might be nearly identical. Now the regression struggles to determine which variable deserves credit for explaining the dependent variable. It's like asking two people to answer exactly the same interview question simultaneously. Their voice overlap. You hear both, but it's difficult to separate their individual contributions. Here's the important difference from the previous two violations. The coefficients remain consistent, but now standard error becomes too large, not too small. Large standard errors reduce t-statistic. That means truly important variable may appear insignificant. Instead of making type 1 error, now we reach type 2 error. We fail to reject the null hypothesis when we actually should. Professionals often detect multicollinearity using variant inflation factors, or VIF. High VIF values indicate that explanatory variables are excessively correlated. The usual solution is straightforward. Remove one of the highly correlated variables or replace it with a different proxy that captures similar economic information without creating redundancies. Okay, now we're comparing the three problems. Notice something interesting. All three violations leave the regression's coefficients consistent. That's why beginners often underestimate their importance. The real damage happens in statistical inference. Heteroskedasticity, standard error become too small. Serial correlations, standard error also become too small. Multicollinearity, standard error become too large. So if you remember only one mental model, remember this: the coefficients may survive, the statistical conclusions may not. And in finance, decisions are beyond statistical conclusions. So today, we learned that building a regression model is only the first step. The real challenge is knowing whether you can trust the conclusions that come from it. Heteroskedasticity, serial correlations, and multicollinearities rarely change the estimate coefficients dramatically, but they can seriously distort the statistical evidence that analysts rely on when making decisions. It's about making reliable inference from those relationships. Once you understand that distinctions, you will think about regressions the way professionals do